The guardrails, knowing when to play. Welcome back to the architect's desk. In our previous briefings, we designed the structure and planted the orchard. But today we address the most dangerous part of the build, human nature. Imagine I asked you to drive a car across a bridge suspended 5,000 feet in the air. The bridge is wide, the road is smooth, and the destination is paradise. But there's one catch. There are no guardrails on the sides. Even if you are a world-class driver, you wouldn't drive at 60 miles per hour. You'd crawl at 5 miles per hour, gripped by fear, paralyzed by the what-ifs. In financial engineering, most people live without guardrails. They have money, but they have no permission to play, because they don't know where the edge is. Today, we install the guardrails. We're going to define exactly when you can spend, when you must stop, and how to know the difference between a market dip and a structural failure. Before we bolt these guardrails into the bedrock, if you're finding value in this architectural approach to wealth, hit the like button. It tells the algorithm that financial engineering belongs on this platform. Now, let's install the first rail. To understand guardrails, we must refresh our memory on the three-basket blueprint. As a yield architect, your wealth is not a single bucket. It is a system of 3 distinct zones. Basket 1 is the safety basket. This is your oxygen tank. It contains your cash, high-yield savings, and short-term treasuries. It is designed to sustain your lifestyle for 2 to 5 years, regardless of what the stock market or the real estate market does. Basket 2 is the growth basket. This is the engine room. This is where we apply leverage, invest in equities, and build the core of our net worth. Finally, basket 3 is the yield basket. This is the orchard. This is the harvest from the apple tree, the actual cash flow produced by your assets. The primary reason financial plans fail is not a lack of money, but a lack of structural integrity between these baskets. Without guardrails, people mistakenly take oxygen from the safety basket to fund a lifestyle they haven't earned yet. Or worse, they cut down the apple trees in the growth basket just to have a party today. This is the equivalent of pulling bricks from the foundation of your house to build a fireplace. It looks good for a moment, but the collapse is inevitable. We are building a system where the party is mathematically mandated, not emotionally decided. Now, let's introduce the first guardrail, the safety brake. In engineering, a safety brake isn't there to stop the machine. It's there to keep the machine from destroying itself. In your financial life, the safety brake is your withdrawal floor. Most people use a static spending plan. They want to spend $5,000 every month, regardless of what the market does. That is a bridge with no rails. A yield architect uses dynamic guardrails. If you want to see the blueprints for briefings 101 and 02, make sure you are subscribed to the Yield Architect. Turn on notifications so you don't miss the maintenance schedule briefing coming next week. Let's look at how the safety brake works in the real world. Imagine you own a rental property portfolio in a market like Oklahoma City. In a normal year, your long-term rentals are producing a steady yield. This yield flows into your yield basket and funds your life. But let's say the economy shifts, occupancy drops, or maintenance costs spike. This is where the lower guardrail engages. Instead of selling the property, which would be cutting down the tree, you engage the safety brake. You reduce your discretionary spending to a predefined floor. You stop the play and focus on the preserve. Because you have a safety basket with 2 years of cash, you don't panic. You aren't a victim of the market. You are an engineer managing a temporary load increase. The math of the safety brake is simple. If your total portfolio value drops by more than 20% below your architectural target, you reduce your withdrawal rate by a set percentage, usually 15 to 20%. This ensures that you never sequence your withdrawals during a down market, which is the #1 killer of retirement portfolios. By installing this brake, you eliminate the fear of running out of money. You know that even in a Great Recession scenario, your foundation is bolted to the bedrock. You aren't guessing, you're measuring. Now, for the part everyone loves, the party rule. Guardrails aren't just for stopping, they are for giving you permission to go fast. If the market is booming and your apple trees are producing more fruit than you can possibly eat, what do? Most people hoard it out of fear. They continue to live like paupers even when they are princes, because they are afraid the good times will end. This is a failure of engineering. The yield architect installs an upper guardrail. We call this the 5% surplus rule. If your portfolio grows beyond your architectural target, the surplus is play money. The mandate is that you must spend it. Does the party rule feel uncomfortable to you? I want to hear from you in the comments. Are you a hoarder or a spender? Let's discuss the psychology of the harvest below. When you hit the upper guardrail, you are essentially harvesting the overgrowth of your orchard. Think of it like a tree that has grown so many apples that the branches are beginning to strain. If you don't harvest them, they rot on the ground or break the tree. In financial terms, this surplus is your reward for building a sound structure. This is when you buy the car upgrade, take the family on the month-long holiday, or invest in a high-risk passion project. Because the math says you've reached the upper rail, you can spend this money with zero guilt. You aren't hurting your future, you're simply harvesting the overgrowth. This brings us to the concept of scalability. The beauty of the guardrail system is that it works whether you are managing $10,000 or $10 million. The principles of structural engineering don't change because a skyscraper is taller than a house. The loads are just managed differently. For a young investor starting their first faceless side hustle, the guardrails might be small. Maybe the party rule only triggers a $100 dinner. For the seasoned investor with a portfolio of long-term rentals, the party rule might trigger a new property acquisition or a luxury vehicle. The percentages remain the same. To maintain these rails, you must perform a stress test. In engineering, we don't wait for the bridge to collapse to see if it's strong. We simulate the load. Once a year, you should look at your 3-basket blueprint and ask, if the growth basket dropped by 50% tomorrow, would my safety brake be enough to protect my yield? If the answer is no, your guardrails are too wide. You need to narrow them, you need to increase your safety basket, or lower your spending floor. The most successful yield architects are those who can balance the discipline of the safety brake with the joy of the party rule. Wealth without the ability to spend it is just a high score in a game you never played. Spending without a safety brake is just a countdown to bankruptcy. The guardrails allow you to live in the middle, the safe zone where growth is consistent and life is lived to the fullest. As we conclude Technical Briefing 03, remember that your financial structure is only as strong as its weakest point. Most people's weakest point is their own emotion. They feel rich when the sun is shining and poor when it rains. By installing these mathematical guardrails, you take the emotion out of the equation. You follow the blueprint You trust the math. You become the architect of your own yield. In our next briefing, we will look at the maintenance schedule, the specific annual rituals you must perform to ensure your rails haven't rusted and your baskets are properly balanced. Build for the harvest, protect the roots. If this briefing changed your perspective, share it with one person who needs a set of guardrails. I'm the Yield Architect. See you in the next build.